Hi and good day, I greet to Dr. Oi. So we're from Group 9, would like to present our portfolio construction analysis. So our main objective to do this assignment is to construct a diversified portfolio based on their sector performance. So we pick 6 industries to do this analysis: beverages, healthcare equipment, real estate investment, food producers, chemicals and financial services. Out of all, we selected 2 stocks for 6 key industry to balance risk and return. For beverages, we chose Spritzer Berhad and Carlsberg Brewery, since Spritzer is a leader in bottled water, offers stable growth, while Carlsberg provides exposure to the premium alcoholic market. In healthcare, we picked Cotton Rubber and Wine Glove Group, since both key players in rubber glove industry. Next is real estate. We choose IGB Berhad and IOI Properties Group, since IGB focus on commercial properties, while IOI develop a large-scale township, balancing steady income with growth potential. In the food production sector, we selected Sime Darby Plantation and FGV Holdings because both major palm oil producer. And for chemicals, our selections are KL Kepong and Toyo Ventures. KL Kepong provides stability with palm-based chemicals, while Toyo Ventures specialize in high-risk, high-reward specialty in chemicals. Finally, in financial services, we selected Apex Equity and Kenanga Investment Bank. Apex focus on equity investment, while Kenanga provide brokerage and wealth management services. Now we move to correlation analysis, which we conducted a thorough review of how these stocks move in relation to each other. So stocks with low correlation reduce risk, while those with high correlation may require careful weighting. Like for example, Spritzer and Carlsberg show a low correlation of 0.0407, making them ideal for diversification. On the other hand, like Sime Darby and FGV Holdings have a negative correlation of negative 0.9526, which we see balance in risk. However, pairs like Cotton and Wine Glove share a moderate correlation of 0.7832 due to their similar market exposure that require proper balance in the portfolio.
Hi, my name is Sufi Daniel, 294444. Now I will be presenting the performance and composition of our opinion portfolio. We will cover the key metrics such as the portfolio return, risk and the Sharpe ratio, followed by the in-depth look at the weight allocation to various stocks within the portfolio. First is portfolio standard deviation. The portfolio risk measured by the standard deviation stands at 2.8004%. This relatively low level of the volatility indicates a well-diverse portfolio. Next is portfolio return. The portfolio's expected return is 0.1230%, a modest but a consistent gain over the evaluate period. Lastly, Sharpe ratio. The Sharpe ratio of 4.3922% reflects a exceptional risk-adjusted return. This metric confirms that the portfolio delivers a strong performance relative to the level of the risk undertaken. Next, let's go into the weight allocation of the individual stock. The portfolio has been strategically designed to maximize return while minimizing the risk. For Spritzer Berhad, this stock holds a significant weight in the portfolio. It contributes a positive with a return of 0.3808%. This choice aligns with the strategy of focusing on reliable, high-performing stocks. Another company is Wine Glove Berhad. This stock has been assigned minimal weight due to its negative return of a negative 0.1390%. By limiting the exposure to such stock, we have effectively reduced their potential negative impact on their portfolio's overall performance.
Hi, my name is Muhammad Amirul bin Muhammad Fazil and my metric number is 294643. So, on this slide, we are comparing the risk and return profiles of 2 portfolio strategies, which is equal weighted and non-equal weighted. These matters impact how a portfolio's assets are allocated and subsequently their performance in terms of risk and return. Let's start with the equal weighted portfolio. Here, each asset in the portfolio is given the same weight of 8.33% regardless of its size or other attributes. The portfolio return in this case is negative 0.1%, and the Sharpe ratio, which is a measure of risk-adjusted return, is negative 3.5%. While it has a low variance, the standard deviation at 2.84%, indicating moderate volatility, this equal weighting approach is simple and provides diversification benefits. However, it does not account for the risk of size of individual assets, which may lead to suboptimal risk-adjusted performance. Now, looking at the non-equal weighted portfolio, the weights are assigned based on criteria like market value or optimization techniques. The portfolio return there is 0.223% higher than the equal weighted approach, and the Sharpe ratio is significantly improved at 4.39%, while the standard deviation is 2.8004%, and the adjusted weighted minimized risk associated with specific underperforming asset and optimized for higher returns. This method is generally favored by investors seeking to balance risk and reward strategically. Equal weighted portfolio offers simplicity and even exposure, but may sacrifice optimized risk-return outcomes. Non-equal weighted portfolio, on the other hand, require more analysis to set the weights but provide improved risk-adjusted returns and show in the Sharpe ratio difference. For investors, the choice between these approaches depends on their risk tolerance and investment objective.
So the portfolio has achieved its optimal level at a standard deviation of 0.0275 with a return of 0.06%, striking the ideal balance between the risk and return. As for the equal weighted allocation, it ensures diversification. A strong performer like Spitzer hard to boosting the return, while the underperformers such as One Growth Group reduce them. So the optimal weighted strategy is to refine this balance by allocating more to stable and high growth stock like IOI Public Group weighted at 30% and Spitzer at 10%, while also including smaller weight for riskier stock like Cotton Rubber to capture the recovery potential. And that's the risk-return trade-off is evident as return increases from 3.45% to 17.45% when the standard deviation decreases from 0.02614 into 0.00214. So the portfolio aligns closely with the CML, which highlight its efficiency in maximizing return for specific risk level while outperforming the risk-free rate. So the diversification and strategy weighted ensure the return above the baseline, leveraging principle of the efficient frontier to deliver strong performance and a well-balanced investment strategy.
Hi, my name is Nur Amanawati Zakaria and my metric number is 295535. In this slide, I will share 3 practical strategies to strengthen our investment portfolio for stability and growth. First, if diversification across the sector. To minimize risk and ensure steady return, we recommend diversifying across a 3 key sectors. First, healthcare, livestock like KPJ Healthcare and Harapan focus on steady growth due to their strong market demand. Second is pork producer. Sarawak oil palm and United Plantation show consistent upward trends, ideal for long-term gains. And lastly is the financial services. Bursa measure offer robust return while Kenanga Investment Bank provides diversification opportunity. And second, we use the performance monitoring and adjustment. Regularly reviewing the portfolio structure, conduct quarterly assessment to adjust investment based on market trends. This helps us stay aligned with outperforming sector and adapt to changing macroeconomic conditions. Lastly is the risk management. Reducing exposure to volatile stock is better. For instance, limit investment in high-risk options like Toyo Ventures and HGV Holding. Instead, focus on diversified stock like Spitzer, which offers stability even during market fluctuation. In conclusion, by diversifying sector, regularly monitoring performance, and managing risk effectively, we can strengthen our portfolio for consistent growth and resilience. Thank you. That's all from me.